maybe since since August or September, silver has very slightly outperformed gold. But so I went from a ratio of like 107 to 1 in April to now 80 to 1 a few days ago. So okay, fine, it's a little bit of an outperformance, but you're counting from 107. That's not a normal ratio. So whatever is happening now, it's not an intermediate top. If it is a major top, it would be like any of the other ones that we've experienced since 1918.
Silver's recent performance has taken a more measured path compared to historical trends. Traditionally, silver tends to outperform gold during the late stages of a bull market due to its higher volatility and smaller market base. However, in the current cycle, both metals have largely moved in unison, suggesting that broader monetary dynamics are driving the rally rather than industrial or speculative demand. Global liquidity tightening, persistent dollar strength, and ongoing volatility in short-term lending markets have pushed investors toward both metals as protective stores of value. Rafi Farber notes that this synchronized behavior reflects rising concern over systemic financial strain, where gold and silver serve as parallel hedges against an over-leveraged global economy. The movement signals growing recognition that both assets are essential in preserving purchasing power amid fiscal instability. The relationship between gold and silver continues to show subtle but meaningful shifts. Over recent months, the gold-to-silver ratio has compressed from an extreme 107 to 1 to around 80 to 1, representing a modest yet significant rebalancing. According to Rafi Farber, this adjustment does not yet indicate the speculative frenzy typically seen in late-stage bull markets, but rather a gradual normalization within precious metals. He interprets silver's relative resilience as a sign of renewed investor confidence, pointing to its undervalued status compared to gold. Historical cycles show that such recalibrations often occur before a broader revaluation, suggesting the market may be entering a consolidation phase before the next upward leg. Silver's stability under pressure hints that monetary rather than industrial demand is beginning to dominate sentiment. Looking ahead, both metals are poised to remain highly responsive to Federal Reserve policy and liquidity conditions. Rafi Farber emphasizes that silver's dual nature, as an industrial input and a monetary refuge, positions it to outperform once confidence in fiat systems begins to erode. If central banks pivot toward easing or renewed stimulus, in that case, silver's thin supply structure and rising global demand may trigger a sharp revaluation, reaffirming its historical role as gold's more dynamic counterpart during monetary transitions. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
My point is that gold is not going to go up and up and up and up every single day until the next printing round starts. I mean, just like it was in COVID, the Fed cutting to zero immediately because there's a bank scare, or JP Morgan says they have to, whatever it is, the big banks come together and say, Fed, we need you to move. And then they print twice, 3 times, 4 times as much money as they did during COVID. Then gold and silver should go up and up and up day after day after day without any kind of pullback at all. But we're not there yet. We are there. The dollar is going to be in a perpetual short squeeze, meaning there's always more debt than dollars exist. So at the point when somebody starts defaulting, then it's like a game musical chairs where the music stops and everybody's got to sit down, and whoever sits down last doesn't get a chair. So when the music stops and defaults start, that's when there's a rush for dollars, and there's going to be a big rush for dollars at some point, and gold and silver are going to sell off just like everything else. It's just that gold is going to sell off less than everything else, just like it did in COVID. Gold sold off during the lockdowns. It did. And it reached a low of 1450, and the miners got clobbered, 20, 30, 40% in a few days. I don't know if it's going to be that magnitude this time. It's going to be the same kind of thing. And then the Fed's going to reinflate. And then at that point, we can say we're in the final sprint. It's going to take a few weeks until the dollar collapses. But we're not there. We got to wait for that to happen. And meanwhile, we can play the game of, well, what was the proximate cause that made gold and silver fall down specifically on October, whatever it was, 21st. And then we could look at the movements in the market. But that's all inevitable. It's always the same story. There's going to be something that is going to cause a correction until the Fed reinflates. So wait for that to happen, and then you can say that there's going to be no more corrections. But until then, you got to stay balanced. We can't be too euphoric and we can't be too discouraged because we're still in a dollar short squeeze where there's more debt than dollars that exist, and that's what's going to happen. Yeah, you can come up with 1,000 reasons why it happens. But before we go into the reasons why, we just have to remember that this is what has happened every time since 1918, since the end of World War I, which was the end of a huge inflation that funded the Great War back then. And then at the end of that inflation, silver outperformed gold until a silver dollar was worth more than a gold dollar. Not that silver was worth more than gold, but if you had a silver dollar coin versus a gold dollar coin, I think they had those coins back then the silver dollar was worth more than the gold dollar. It was 1918 was the first time this century. You had it in 1968, 1980, 2011. Every single time there's some sort of a monetary reset, minor or major, then silver always handily outperforms gold. Like, obviously, what's that word? Not sporadically. Like in a frenzy. There's just a huge bid for silver, and we didn't see anything near that at all. Like we were applauding, and we were like, giving a nice little polite round of applause to silver when it finally caught up to the rate that gold was rising, and even that wasn't every day. And so maybe since since August or September, silver has very slightly outperformed gold. But so it went from a ratio of like 107 to 1 in April to now 80 to 1 a few days ago. So okay, fine, it's a little bit of an outperformance, but you're counting from 107. That's not a normal ratio. So whatever is happening now, it's not an intermediate top. If it is a major top, it would be like any of the other ones that we've experienced since 1918. If you want to go into the why, it depends where your vision is most keen, what aspects of the gold and silver market you connect to or you look at, are you able to analyze the best. And I'm always broadly monetary. So whenever silver outperforms gold, it's a signal that credit is breaking down, and either the Fed intervenes and it saves the credit market by adding more credit. Adding more credit means adding more debt, because it's the same thing. Credit and debt are two sides of the same coin. So if the Fed's able to add more credit, add more debt, and then it's like a borrower who you're demanding he pay you back, and then he gets more credit from someone else, and he's able to pay you back in credit, and you're like, okay, fine, so I'll extend the term on your loan, and you'll keep giving me this credit. So that's what the Fed does. It just keeps extending the loan. So as long as it can do that, it can calm down the money markets and expand the credit markets. But when silver outperforms gold, that means either the Fed has to reinflate and suppress the monetary prices in terms of credit, or it's done. And this time they'll try to reinflate and it won't work. It'll be done. And we're just waiting for that last surge of silver over gold. It's going to end somewhere around 15 to 1. We don't know exactly when, but my guess is there's a bank crisis of some sort. The Fed cuts to zero, starts QE again, and then the metals just go up, limit up one day, limit up day 2, limit up day 3, limit up day 4. It's going to be like the end of 1979, the beginning of 1980, except this time there's going to be no correction back down.
According to financial analyst Rafi Farber, silver could soon make a major move, possibly reaching $85 to $150 per ounce. He believes this wouldn't be a speculative spike, but a natural revaluation that reflects silver's real-world scarcity and growing industrial demand. Farber points out that the global economy is still caught in a dollar shortage, where there's far more debt than available cash. This imbalance creates sharp pullbacks in the market, but history shows these dips often come before big rallies in precious metals. When the Federal Reserve eventually restarts money printing and injects new liquidity, he expects gold and silver to rise sharply, signaling the next wave of inflation and a weaker dollar. Farber also highlights the gold-silver ratio as a powerful signal of what's coming. Each time the global financial system resets, silver tends to outperform gold as trust in credit markets fades. He suggests we may be approaching another one of those turning points, likely triggered by a new banking or debt crisis. As governments and central banks respond with more easy money, silver's dual strength, as both a store of value and an essential industrial metal, Rafi Farber believes patient investors will be rewarded when that moment arrives.
So right now the ratio, the bank reserves are falling. They're now at like 2.98 trillion, like below 3 trillion. And this week's number, which should be out in a few hours, I think 2.5 hours it'll be out, and I'll check it. It should be like something like $80 billion less. because the government shutdown, it means that the government isn't spending as much money. It's spending, I think, on mandatory spending, but not on discretionary or something like that. I don't know exactly what the technical details are, but it's spending less money than it otherwise would. So all the money that's sucking out of the bank system is not being spat back into it. So they're raising money. I think the total dollar cash hoard that they have was like $930 something billion. It was whatever it was like 60 or 70 billion dollars more than it was last week. So that's money that's taken from reserves. Yeah, and now you have 2.988 trillion minus about 70 billion, so it's like 2.91 trillion or something. And the amount of repos that are being traded is over $3 trillion. It's like 2.98. It fluctuates between like 2.95 trillion and 3.0 or 3.1 trillion, something like that. Like how much longer can this go on? I mean, we're looking at the repo rate. It's called the SOFR rate, and it keeps wobbling. It wobbled again 2 days ago, up 7 basis points, and now it was down 3, and tomorrow could be up 10. Who knows? If it's already wobbly, that means things are already tight. And the standing repo facility that the Fed instituted after COVID, it provides emergency repo money to banks that can't get it because maybe the reserves have run out. It's being used. And sparingly, like a few $1 billion a night. Okay, well, since monetary analysis is my bent, and that's how I see the world, if you read these books on hyperinflations, isolated hyperinflations in the world, I remember reading once, maybe it was When Money Dies, I forgot who the author was, but it was about Weimar, and he was talking about during the late 1923 when the hyperinflation was in full swing. You had government agents of the Weimar Republic just like raiding people and stealing whatever hard money they had on them to try to get ahead of the hyperinflation, where they had gold coins in their pockets or silver coins, and they even outlawed platinum because some people were hoarding platinum and using platinum for exchange because they couldn't use the stupid paper mark. Even back in 1923, platinum was still being hoarded as some kind of a money, as some better money than paper money. So the reason platinum would be disjointed, not necessarily because there's a sudden demand for catalytic converters or whatever, platinum is used for primarily, and that's primarily catalytic converters in cars and other strange niche kind of things that I really have no understanding of. I don't understand car parts or anything like that. But since it is a pseudo money and the liquidity is so low, people could think, well, gold's too expensive. It's like $4,400 an ounce. I mean, there's probably a little bit of a physical premium on it. To get an ounce would probably be $4,400 today, despite the fall. And they might get some silver, but they might also want something that's more value dense just to preserve their wealth. And they don't want gold, and they think the platinum is really cheap because, they think of the 90s and like, okay, well, platinum was much more expensive in the 90s than gold was. That's why like the platinum credit card is considered a higher line of credit than the gold credit card, that's left over from that decade. So in their mind, platinum could be more valuable. And as markets shift from industrial to monetary, industrial demand is demanded by the creators of whatever piece of capital equipment they're producing for industry, right? Or consumer good. But monetary demand is by definition everyone. So even the slim amount of monetary demand would be more than the very specialized industrial demand for platinum. If you have even a tiny percentage of monetary wake up of people looking for a preservation of value and they don't want gold because it's too expensive, then they'll see platinum is cheaper, so want to take that. Maybe they'll go for it. And that could overwhelm the very, very thin platinum market as it's overwhelming the silver market, which is why you're seeing all this disjointing through London and New York. What that means just very broadly in a broad brush strokes is that the monetary demand for silver is starting to wake up. And the silver market it's not structured for that. It's structured for silver as a commodity. And it doesn't have the capacity to satisfy the demands of people that are demanding silver suddenly as money because they're panicking. I think it's just a peculiar thing going on with London because the ETFs happen to be stored, their metals happens to be mostly stored in London. I think SLV has a little bit in New York, but the amount of silver being stored for SLV New York hasn't changed in many years. It's the same in the same JPM vault. What changes is the vaults in London. So it's just signaling that London, which is the main physical spot market for the world, is short on silver. Not that they're selling it short. I was saying they don't have enough supply, and you can see that in the float because they have to store for the ETFs. And though ETF storage is not anywhere near where it was in 2011, it's slowly building back to that as investment demand is growing. So silver squeeze was an interesting movement back in February 2021. Now is when it could really succeed, because if people bought a bunch of silver ETFs, then they could really blow that spread out, because then London would really need the silver to be shipped there immediately. It's just so it could keep the ETFs in line with price. Because what would happen to these ETFs this is my theory, that if SLV, for example, couldn't store or couldn't buy silver because there wasn't enough in London, then how would it be tethered to the silver futures price? It couldn't be tethered, and then you'd have the SLV, because it was lacking shares, just spiraling higher and higher and higher, and then that would create a feedback loop where it would force London to import silver from anywhere it could at any price, just to keep SLV under control, and then you'd have this positive feedback loop that I don't know how they would get it back in control. That's what silver squeeze was trying to achieve, and I think it could achieve that now, specifically because of the spread between London and New York. But why I say it's not backwardation is because New York silver is a different good from spot London silver. According to Mises, in his book Theory of Money and Credit, he differentiates between goods in different places, or technically different goods. They're similar goods, but they're different, because let's say a bushel of wheat in a starving African country is not the same good as your marginal bushel of wheat in some warehouse in Nebraska, or whoever grows wheat is. It's worth very little there, but it's worth a lot in Africa, or whatever country might be starving there. So what backwardation would be is New York spot silver, meaning October silver would be this month, would be more expensive than, let's say, December futures silver. That we're not seeing yet, but we will see that. And when we see it, we'll know that silver is really in backwardation, and then things could get pretty spirally.
The US dollar's recent rebound, typically moving opposite to gold, has encouraged investors to take profits after the metal's impressive 50% rally this year. At the same time, US bank reserves have slipped below $3 trillion, reflecting tighter liquidity and increasing pressure across the financial system. With government spending curtailed during the shutdown, less cash is circulating through banks, while repo transactions remain above $3 trillion daily. The Secured Overnight Financing Rate, SOFR, has become more unstable, and the Federal Reserve's emergency lending facility is being accessed more often, suggesting underlying financial fragility that could precede broader market corrections. Gold and silver face a turning point as US liquidity tightens and repo market volatility deepens. Bank reserves below $3 trillion highlight systemic stress, while the dollar's rebound has cooled gold's rally. Yet, historical trends suggest renewed demand for precious metals as investors seek stability. With silver supply tightening and platinum gaining traction, analysts foresee potential Fed easing that could propel gold to new highs in the coming cycle. If you found this information valuable, make sure to hit like and drop a comment below with your thoughts. Don't forget to subscribe and turn on notifications so you never miss the latest updates. Thanks for watching.